Goldman Sachs just announced that it's cutting its growth forecast for the first half of next year down to 2% from an earlier prediction of 2.4%. And if that's not bad enough, they say it's only going to get worse in the second half of the year. But at the same time, they say they are not particularly worried about a recession. So what are the biggest risks to the economy as we head into next year? And when it comes to your money, where should you consider investing and what should you try to avoid? Well, we've got a great panel now to help weigh in on this. Quill Intelligence CEO and Director of Intelligence Danielle DiMartino Booth, Bianco Research President Jim Bianco, and University of Maryland Professor Emeritus Peter Morici. Danielle, I want to start with you because you have been very vocal in your writings, your daily writings, your social media posts about your concern over credit debt here and the sort of idea that maybe this is the biggest source of risk right now.
We've been watching investment grade bonds in particular since early this year. I mean, this is the last day of this year, but we've been watching that as being a potential catalyst. What we saw with the General Electric event was that it indeed can be something that causes companies to preemptively begin to shrink. And more recently, of course, we've seen the end of the panic buying, and we've seen 5 of the regional Fed manufacturing surveys show slowing. This morning's data that was released in a very quiet data release day out of Dallas was a bloodbath, Charles. We even saw employment tick back, which is a result of really oil prices being down 45% from their high. And we're also seeing consumers' perceptions of job availability begin to come back in, which is the latest consumer confidence report. People's perceptions of job availability fell at the fastest pace since 1977 when we were both very much younger. And then there's housing. So I think Goldman has got good reason to say that they see the economy slowing going forward.
And yet, Jim, if that is indeed the case and the tea leaves are becoming more obvious to read, this adds more confusion to the Federal Reserve. This last meeting, the dot plot suggesting at least 2 more rate hikes, all while they're taking so much accommodation every month out of the economy. It seems to something is not right. Someone isn't right here.
Yeah, and that's why the market had its bad reaction, over the last 2 weeks following the Fed meeting. The natural state of an economy, the U.S. economy, is to expand. It expands faster or slower. The reason we have recessions is because something breaks it. And the leading cause of breaking the economy is Federal Reserve policies too tight. They raise rates too much, invert the yield curve, and we have a recession. That's what the markets had their hiccup about over the last couple of weeks. The Federal Reserve says they're going to reduce their balance sheet. That's a form of tightening. Then they said that they're going to raise rates 2 more times. That's a form of tightening. The market is worried that's too much, and the Fed has been slow to respond to it, and that is the biggest fear I think the market has. I think it's rebounding because it's now decided the Fed gets it. There's going to be no rate hikes in 2019. But Friday, when Chairman Powell speaks, if he starts hinting around that, yeah, there could be more rate hikes, I don't think the market's going to take it well.
Peter Morici?
Well, I think that Chairman Powell does have to back off. I don't think he has to say no more rate hikes, but I think he has to indicate some easing back. I mean, he indicated when they raised rates on December 19th that he thought the interest rate was now kind of at its neutral level. Yet they issued a statement in a dot chart that has it going up to about 3% sometime in 2020. Now, he really can't let that kind of mixed communications come out. He's got to talk to his board about doing something about that. But more importantly, it seems to me that the biggest problem we have is Donald Trump. Not Mr. Trump, not deregulation and tax cuts, but all of the negative karma in New York. It's no accident that I think if you take a poll of the people that sit at Goldman Sachs, you'd find that probably 4 out of 5 of them are Democrats and like this guy to fail. Next year, there's going to be a lot of stimulus in the system. Now, for one thing, the tax cut impact, now that's passed for consumers. But gasoline's a lot cheaper. Right. An awful lot cheaper, and that's going to increase household income in real terms. That's a positive. The second thing, you have to say, what's going on at the Dallas Fed with those indicators? With the level of activity, it's not the price of oil, it's how much drilling is going on. Look at the Baker Hughes report and how much drilling activity is going on. It seems to me that somebody's going to be making the pipe that's going into the ground for all those wells.
Danielle, by the way, Peter, your Goldman comment, I would have stood up and give you a standing ovation, but I'm tethered to the chair.
It's not just Goldman. Read Bloomberg, and all the traders read Bloomberg.
Every day I read them all. Every day I read them all, my friend. It's part of my.
We read the same stuff.
But it's tough. It's tougher now to parse out facts from opinion, and opinion that's based on ideology, not fundamentals. Danielle, in this environment, people aren't sure where to put their money. Equities certainly look attractive from a historic level. Your forward PE ratios under the 5-year average, not threatening anywhere near where, bubbles are. Bond yields are yo-yoing. One day, we're breaking near 3.5. Now we're near 2.5. We can't make sense. How do you help investors who are saying, hey, where do I find some safety in this environment?
Well, there are many ways to get defensive with your portfolio. And because stocks have come down to the extent that they have, there are some great dividend-paying stocks out there that would weather even a recession, Charles, and people should bear that in mind. And the one favor that the Federal Reserve has done the average saving American is that there's no longer shame in holding some of your money in cash, because for the first time in a generation, holding cash actually pays a decent return. So if you decide that you want to go with the notion that the economy is going to slow in 2019, there are plenty of options. You have to get out and talk to people, though, beyond just the sell side, because
Sure.
as you noted when you first opened the segment, Goldman says the economy is going to slow, but it's never going to go into recession. Be careful of these people who are beholden to making sure that investors stay long only the equity market. That's a fallacy, Charles.
Real quick, Jim, a defensive area or areas that you may want to share with our viewers?
Yeah, one of the best performing areas this year, although it lost money, because everything lost money this year, one of the more unusual years that we've seen, has been bonds. The bond market has rallied. We're now at a 268 on the 10-year note, which is the lowest yield since February. That means the price is going up. I think as we move into 2019, the bond market's going to show maybe the economy moderates. We don't have to talk about recession. Inflation expectations go down. That's a good cocktail to be long the bond market, and it should provide one of the better returns as we go into the next year.
Hey, 3 great minds. That was a great cocktail for this segment. I really enjoyed it. I think the audience did too. Danielle, Peter, Jim, thank you all very much. Happy New Year.